financial projection.
Okay.
Financial. Do you need the second video?
Yeah, we did already the first video and we did the second video. So now I can upload the financial projections here.
Maybe explain the term sheet, for the founders, investors.
You want to explain that while I get this ready here? Hold on, let me just.
Okay.
Sharing.
But maybe we look at the financial. I can explain the financial. The projection.
Yep. 1 second. Can you see the Excel on your screen?
Yep.
Yep. Okay. So in the I'll just zoom it out for a minute. We can zoom back in. In the PDF presentation on Kayla, which I imagine you have all seen it, there's a slide that is the cash flow projections, and it's this slide here, right? This below, I'm going to zoom in for you guys, but this here below is the same cash flow projection, but in more detail, right? So we can zoom in here, and you can see the different titles here. So this is month 1, 2020, so January, and here we are in month 5, right? So you can see this is the mineral tonnage, the gold ounces recovered, the revenue after the costs of the processing, CapEx, the drilling campaign, that is what we mentioned that is so important for developing and knowing the different veins and grades that we have for production, de-risking ahead of the mining, operating cost, OPEX, mine concession. So we paid this to the owner here in month 3 and 4, which gave us the right to exploit. And we have two additional payments for the 100% acquisition of his deposit, of the mine. External investment, this is the founder's investment. It's $2 million. That's 2.3, but the 3 we already have. So it's the $2 million founder's investment for 20% of equity in Trident Minerals. So we have Trident Limited BVI, which is the SPV or the vehicle that the investors are using, and that vehicle will own 20% of Trident Minerals. The investors have a payback on the projection. Even though it's 20% equity, the founding investors receive up to 50% of available dividends or distribution until they are whole. And then after that point, it reduces down to the actual share that they hold, which is in this case 20%. So if we go along a little bit, Mr. Wee, I don't know if you want to add something to that, but I'm just going to go along here.
Yeah. Maybe you can explain. The build-up of the number of tons and the number of ounces and the revenue we earn, and then the payback to the investors on the 15 month. But we're already coming to the 6 month already. By the time investors come in, it'll be June already. Right?
Yeah.
They'll come in June, July, so they are really midway. So to 15 months is much. So probably they get the payment in April, I suppose. Right?
Yeah,
this
so
is
the first
$1,600 dollars per ounce.
That's correct. Yeah, so the first payment is here, month 15, and continues. The full payback would finish. Let me just make it better here.
You get it in 2021 to 2022.
Right.
At
1,600. Right.
At 1,600. If gold price reach 2,000, they probably can get it by mid 2022.
If it was gold price was 2,000, it would be this blue line here, and if we consider the 16 million on the blue line, would be around here. Would be year 4, a little bit after year 4, as opposed to year 7.
Yeah, we out of 16 million after year 4, we have 20% as 3.2 million now. For the investors, 2 million because they're 20%, but they get 100% refund of the capital from year 15 to 2022. Okay, the intention is to refund the capital for founders, investors, to get the refund of the capital from the 15-month onwards. So if gold price reach 2,000, we'll get it faster, right? By mid 2022.
Yeah, this is the 2,000 line is the blue line, and instead of being 16 million, the impact of the increase in the gold value would bring it closer to 30 million in 7 years. So if we wind that back to the 16 million, it's closer to 4 years as opposed to 7. That's the positive impact that the increase in the ounce price has on the profitability of the project. And this is just talking about the 38,000 here, 38,000 ounces over a 7-year period. And you can see here that this shows that the mineral ends on year 7. But the reality is we are drilling all the way along, right? This is the drilling column. All the way along we are drilling, so we're continually adding additional ounces and additional years of production. So it's presented here as though in year 7, the business ends. Well, it's not the case. It's just, like I said before, we can't do a 70-year projection, right? We do just focus on 5 to 7 years, and we update it every time we drill. And another important piece of information is here. So this is our gold ounce cost, pre-drilling gold ounce. It'll be updated post-drilling. This is the drilling campaign. This is the all-in ounce cost. This is not just, many companies just demonstrate their operating costs. So many publish on the stock exchange. We have we can extract our OPEX is $600 an ounce, or 800 or whatever it is. That's this number, right? But you got to consider your capex, your withholding tax, external processing plant fees, and cost to freight, extract, etc., as well as a drilling campaign cost to discover ounces, right? To discover the ounces you're going to be mining. So it brings us to a total average, 7-year average of 1,054. However, in our ramped up years, it's about 800, meaning as you increase the mineral production, the ounce cost reduces. So if you take it as an average of 7 years, 1,000. If you take it from year 3 or 4 onwards, it's about $800 an ounce approximately. So then we talk about the ounces, and this is what Mr. Ree was referring to in the beginning. So Kayla 2 is what we're focusing on, and Kayla 2, today what we're focusing on. Kayla 2 is the budget that you saw here, right? The 7-year projected cash flow. And that's based on 38,000 ounces. The potential is 351 from Nivaldo's Rojas, the chief geologist memo, and he explains there how he calculates it based on what facts. So if we mine 38,000, it leaves us with 311. So if we were to drill that 311 from our earnings, we could have, this would be the cost of proving that 351 per, total 351 as per the memo, would cost us 2.65 million. It would put us in a position where we could have a potential exit, a potential sale of Kayla 2 at a value of $200 per ounce for the in-the-ground ounces, meaning the drilled ounces, right? So that would give you $59 million. Now, if the gold price is higher or lower, this number can be higher or lower. There's a number of mining companies that don't go into production. They just drill. There's a good example in Argentina, 2012. They drilled 2 million ounces in gold in resources. They proved it through drilling, and they sold that project to Yamana Gold for over $400 million in Argentina. And Argentina is a high-risk country in comparison to Chile, right? So it gives you an idea that your value of your mine is not just your cash flow. In fact, many times your value is the deposit. In fact, the deposit is more valuable than your cash flow. For us, we need cash flow because that way we can continue to grow the deposit through earnings, as opposed to being a public company where we publish our discovery and our results, and that capital that we get through being public is what we use to pay salaries and to drill and to grow. We need cash flow, right? So that's why our model is identifying high-grade deposits in Chile with big upside potential, converting it into a production plan, near-term production, quick payback, and the potential to be something a lot bigger. So if you add the Kayla 2 to the Kayla 1, Kayla 1, as it says here, there's no information ready. As I mentioned, just this week, we discovered there's 2 veins. We haven't published that information, but we will be. Geologists will be doing a memo, an update on the resource potential of Kayla 1 and the best approach to define it and drill it. So this is an estimated cost, total cost, of drilling Kayla 1, which would have a potential exit value if these ounces were confirmed, proven, of 65 million, based on a $200 per ounce fee, okay? So this is just to give you an understanding of the value of the deposit and the value of joining this project, the potential value, other than just the production value. And if we were to run our own processing plant, there's an estimated cost of $41 per ton. It would be a defined cost once we do our metallurgical test work, which would be post-drilling, right? So you can't get yourself too far ahead. You have to do everything in stages. But every stage, you get more facts and more data, and you de-risk your project further and further. So going back here to the 7-year cash flow. So, Mr. Wee, would you like to add anything to that?
Going back to the cash flow, okay, based on the current cash flow and what we're able to extract and convert to cash, we will be cash flow positive. We'll be cash flow positive from the 15 month. Leon? We'll be big surpluses. From the 15 cash flow positive, we have to fund the initial capital, setup costs, drilling costs, and so on, and pay for the concession. From the 15 month onward, we'll be cash flow positive, but we are basing on $1,600 per ounce, right? And then after we get back our money by 2022, we get back our money at 1,600. My goal is 1,000. It could reach 2,000, which I think it can by this year. It will reach 1,800 quite easily. This week it was 1760. So it's just within striking distance. The movement can be a couple of days, it'll be 1,800 already. And so if assuming that we are able to, if we would, of course, if gold reach 2,000, we will be able to get back our money by mid-2022, which is just about 2 years from today. But we get it progressively, right? Progressively from April next year. 15 months is actually much, but I presume that you got to get your money the following month, or you accumulate it quarterly, then you pay out. Okay. So after that, we will be entitled to dividends. Dividends either payable in coins, in gold coins, gold bars, or even US dollars, all right? I mean, these are the choices that you have. So we will be entitled to dividends. Maybe we keep half the income for buying new concessions or more drilling or whatever, or to exploit Kela 1. Because if we can exploit Kela 1, we have two flow of income, not one, two flow of income. So our cash flow is actually very positive from henceforth. After the 15 months, we're cash flow positive.
And so just to add to that, Mr. Wee.
Yes.
So, sorry. Just to add to that point, opening Kela 1 is less expensive because you already have it's less expensive than starting with Kela 2 because you already have campsite, your infrastructure. The same chief geologist runs Kela 1. The same chief engineer manages Kela 1. The same management team, CEO, meaning you don't have to double up on your upper management. You just have to increase your equipment and your miners, right? So there's an optimized earning as you grow your company. And the same can be said for having a processing plant. So the processing plant that services Kela 2 can service Kela 1. So Kela 1 doesn't need to buy a plant, get a new Nivaldo Rojas, get a new CEO, or get a new chief mining engineer. That same cost, that same core people are used for all of it, right?
Are you saying that we don't have to pay loan a second time?
No, okay. I wish, but no, you do not have to.
We will gladly take it, okay? Now, so the assumption of the grades, that's number one, the grades, because your assumption here is 6 grams per ton, huh?
Yeah.
And you think you can average for 8 or 9, huh?
I can't guarantee anything, of course, but there's a strong possibility based on the current information of the vein and the previous production and the sales of the previous operator that we could reach those type of grade averages, especially heading. I sent some pictures to Mr. Wee this morning from the mine production. And they're not the clearest, they're not the best pictures, but they are the miners taking a sample from the vein today. Today the vein's a meter wide. This is our production vein. It was about 40, 50 centimeters. And the mineralization has improved. So we are heading towards a known high-grade target. So as we go closer, the mineralization should improve, right? So we expected 80 meters, and we are about 50 meters, and already we're seeing an improvement in the grade and in the mineral, and through the artisan sampling, we can see it, right? In about 1 week, every week later, you have the grade of the mineral today. So what we extract today, I'll know in about 7 to 10 days, right? So that's and the other thing we're doing, Mr. Wee, is we're already doing that cross section. We're heading towards the parallels, so that by next month we hope to have crossed through 1, 2, and up to 3 parallel veins, which will increase our production level. As you can see, it must increase as per our mine plan. So you can see it's 300 here, 550, 880, 1200, 1000, 1800, 1900. So it's about a month's worth of work for the mining engineer and the geologist to develop the mining plan. It's a massive Excel, and it goes meter by meter by meter by meter, a sequence plan, and that's what we follow.
Okay, so what I like is that the team here is very professional. But if you look at the 19 to 24 month and the 36 month, can you zoom in? I can give you an illustration. So zoom the 19, 24, and 36. Can you all see? This is in your Dropbox. Huh? Okay, the top column, the 36 is the third year. Okay, 36 is from 25 to 36. 19 to 24 is, let's say, after the 19 will be from July next year until December. 19 is July next year, right? July next year until December next year. Okay, you get 11.93 tons. Okay, 1924. Okay, and then you get 2,540 ounces, 1924. Then you get the revenue 2.797. We pay for processing costs, but if we are when we raise our phase 2 fundraising, okay, because I'm going to share with you the valuation. Our revenue right now is 2.797 because we pay for about 30% for processing, right?
Yeah, and it's only 6 months of the year as well.
This month, for 6 months, we get about $3 million, 2.797 million revenue, and on the year 8.314. What is the implication if gold reached $2,000? What is the implication? Because your cost of production is 1,050. Right, your cost of extraction and so on is 1,050. At 1,006 you got 550, but at 2,000 you got 950.
These are the years, Mr. Wee, and this would be the impact of 2,000. So you can see you're reaching your 13 to 18 million accumulated cash, available accumulated cash.
Okay, number 4 is this is based on 2,000, right?
This is 2,000, correct?
2,000. So instead of getting 7.1, we are going to get 13.9 million if we reach 2,000. Today is 1,700 plus. You know, 1,030, 50, you know.
This is the 1,600, and that would be at 2,000. That's the difference in earnings: 600,000 versus 2 million, 2 million versus 7, 7 versus 13, etc. You can see the impact of the gold price.
Number 3 is what is based on 1,600. Number 3 is what? 1,600?
This is 1,600, yeah. 1,600.
Number 4 is?
And this one here is 2,000, the ones highlighted. So 16
so instead of getting the second column is, okay, what is the second column? The second column is...
Second year.
Is that...
Oh, sorry. Yeah, so this is 1,600, year 1, 2, 3, 4, 5. This is 1,700 here, and this is 2,000, and this is 3,000.
Okay, the second column is 1,700, huh? So 2,000 would be... Okay, so let's look at the third year. 3 is third year, right?
3 is third year, that's here, yep.
So instead of getting 3.864, if it's 2,000, we get 7.109, is that correct?
That's correct.
7.1, that is... 7.19109 is okay. Are we getting numbers correct?
Yeah. So this is this here is based on the this graph, which is the accumulated cash flow, right? So your total accumulation is 16 along here. So it's not actually year by year, but it's the difference of the total accumulated cash, which you can see comes from, in this budget, it's this cash flow, accumulated cash flow, right? So we zoom out a little bit, sorry. You can see following along that, it reaches 16 million total accumulated cash, which is the same as here, right? All your totals.
Okay, John, the gross revenue is 8.1314, right? What is the net income is 3.5, right? Net income is 3.5, right?
The 3.5 is the OPEX.
Oh,
right?
So now let's look at the third year again. 3.5 is the OPEX. So what is your net income for the year?
So after all expenses, including paying the
capital,
paying the founders, it's
still got 1 point.
It was 3.7, but after paying the founders, you have 2.0. 2 million available after paying
2 million
of to the.
But our revenue based on 1,600 is 8.3 million. Huh?
That's correct.
8.3. So at 2,000, how much will we earn? How much money would be earned?
I don't have that. I don't have this Excel on set up that way, but the accumulated cash in that year would be a lot higher than 2.7, as you can see here on year 3. Instead of 2.7, your accumulated cash would be 3.8 at 17, 7.1 at 2000, and 17 million at.
Our accumulated 7.1 million, which is a big number.
Which is different.
Okay, what we are sharing is that after you get back your capital, your investment will be worth at least 5x to 10x.
Yeah.
Because based on the valuation, based on the deposit value alone, based on that, you can value it based on deposit value, or you can base it on cash flow, right? You can base it on cash flow.
Yeah,
Okay, I mean, I'm just doing a simple calculation. The total value of deposits is worth about $100 million. Okay, but we are valuing our company at $10 now, at $10 million right now.
That's right.
So if the deposit is worth 150 million, we are 15x. But if it's worth 100 million, it's 10x. Okay, so we have the potential to sell it for 10, 15x if you want to.
That's correct.
So that is the value of company, but we have very healthy cash flow, and then the board of directors have to decide the dividend policy. Okay, the dividend policy depends on how much additional capital expenditure we have. If we pay half the dividend, or we pay a good dividend, then we can expand with the rest of the money. We can expand
and create more income from Kayla 1, for example.
Kayla 1, you double flow of income. Yeah.
Yep.
So you got good cash flow, but you get back your capital by. At 2000, you'll probably get back your capital by mid-2022. Huh?
Yep.
Okay, so around 2022 mid, you'll get back all your capital, or just after the mid-year, after we compute the numbers, we can return back all your capital. Okay, but you receive your capital refund progressively after the 15 month.
That's right.
Okay, so okay, look at the numbers again. The other calculation. I mean the reserve. How much you calculate reserve? How much is the value of the reserve? Okay, this table. Okay. So this is based on $200 per ounce. If let's say our reserve is a total of we got reserve of 600,000 ounces. 600,000 or total is 700,000 ounces. If we can drill. This has been drilled and confirmed, right?
Yeah. So if you drill these ounces, you prove them through drilling, which the cost is listed here, and the cost is also listed here, right? 7 million in total cost, which can be paid from production, or from a loan, or from another raise. You would be looking at a exit value of 59 million for Kayla 2 and 65 at 200 an ounce, meaning you're selling your ounces for $200 a piece. You may sell them for more than that, because it moves with the gold price, right? So it's 120.
Yep. So
7 investment, 124 million.
Okay, if it's $2,000 per ounce, how much can you use? The figure should be at least $100 more, huh?
Yeah, it could be up to $100 more, $250, $300, and remember, post drilling, meaning our drilling campaign, which is starting now. Post that drilling campaign, we will update the potential of Kayla 2, which could increase to beyond what we believe it is today. It could decrease, it could increase. More than likely, we believe it will increase. My experience working with Nivaldo Rojas, the geologist, he always puts down conservative numbers, and when we drill, we always end up discovering more. At least that's been my experience working with. The last project we drilled was almost 17 to 18 kilometers of drilling. We are talking in this project about drilling 1.5 in this first 60 days. More than that in the life of the project, but just in this 60 days to give a bit of a understanding of scale, of size.
Okay, so if we can prove Kela 1 and Kela 2, the value of our reserve is actually based on 350, 700,000. It is worth about worth about 140 million. 140, but currently the valuation of our company is only 10 million, right? For founders. For founders is 10 million.
That's
right?
Correct. And that's just the ounces. That's not your value as a positive cash flow producing entity, as a going concern, as a business. It has a different value because of its earnings as well. This is just the ounces.
If you want to sell it outright, huh? Okay, so our intention is the next phase of fundraising to raise between $3 to $5 per share. Even if we raise at $3, the company is only worth 30 million. At $5, the company is only worth 50 million. But the company is potentially 150 to 200 million.
That's correct. That's what we see.
If gold prices go up to $2,000 per ounce, or even higher, our valuation could be much, much higher. But the beauty of it is that we have a mine where we do the drilling and we're producing the gold and producing the income. So the investors see the cash flow as well.
Yes, it started already this month. It's not like other mining companies that need 3 years to 7 years to permit and to operate, where you have to, you invest in the shares and you have to hold on for the ride and hope that they get their permit, hope they ever get to production, hope they can have enough water, hope they don't have a community issue. This mine was producing already. We just took over the license. We were able to fast track because Chile, there's no community. This baby was born in coronavirus. So we do blood tests every 2 weeks. The miners are tested before going on shift. They're isolated for 1 week at a time. They take a 1 week break with their family. So it's easy access, no high altitude, next to the main highway of Chile. But look, regardless of all of this upside potential that we are wanting to explain and share with you so you can understand the big picture, our cash flow model and payback is based on this number, 38,734 ounces.
Out of 100,000 potential that we have. Huh?
Yep, that's this number here. 38,000, 7 years production, 16 million. At 1,600 an ounce, right? So it's a very conservative approach.
Okay, maybe we can invite questions. I'm sure our Zoom partners here will be delighted to ask questions. Can we invite questions?
Yep.
Yes, Mr. Wee. I see that all the projection is for the gold prices to go up. I'm not pouring any cold water in the project, but there should be some projection to say that if the gold price don't go up, but do come down like in the past, to say 1,002 or 1,003, what will be our bottom line like, how long will recover? Because this is a very positive projection that the gold prices will keep on going up, but not forgetting that gold price also at one time 1,002, 1,003, and stay there for a long, long time until very recently.
So Kenneth, can you see the screen in front of you?
Yes.
This is the all-in gold ounce cost over a 7-year period, okay, based on 1,600. But regardless of the ounce price, it's our cost. So if the gold price increases, so the only thing we have to be concerned about is this number. And today our projection is based on 1,600. The gold price, as you know, is over 1,700. And our cost, coming back to your question, is 1,054. Gold hasn't been 1,054 for over a decade.
Okay, but I thought in the illustration we should show that if the gold price go down to 1,002, 1,003, then what will be, what will be the investors can expect to get,
So on a negative projection that is lower than where we are, as I said to you, we are going to be profitable at 1,200 or 1,300 because of our cost being 1,054. And actually, if you go year by year, on year 2 or once we ramp up to 2,000 tons, it goes to around $800 per ounce. So it puts us in a very privileged position in the gold mining business that we have a cost so low. As I mentioned, you can do your own research. The majority of the mining costs around the world are far above that number. 11 to 1,200 is typically what you expect. And those are operating mines. So ours goes from 1,000 down to 800 as we expand production. So it puts us in a privileged position that if that reality was to come to fruition, our cost is 1,054 average on 7, around 800 from year 3 onwards.
Okay, I have one more question. Is the OPEX operating expenditure, this 650 is current. Is there a projection that this OPEX will go up in the coming years?
Yeah, I mean, we have contingencies in place. That's actually the average over the whole 7 years.
I see. Okay.
So we've averaged it out over the whole 7 years, which of course, these first years unfairly give us a high cost because we are not running yet, right? So we are ramping up the project, and as we ramp up, the cost decreases. So we took if we were to project this for 10 years, the number would be much lower because the first couple years or the first year is the most expensive because your extraction amount is ramping up. As you develop and open up the tunnels, you increase the production. So your costs start to reduce, right? Because your tonnage and your earnings increase. And that you can see here. This is the tonnage.
Mm-hmm.
And you can see how we are 300 tons this month and reaching 2,000 tons around here, month 15, 16. And you can see how that has a positive impact on the cash flow.
You mentioned at the beginning that this is every investment carries a high risk. This is expected high return, and therefore the risk is also high. Could you share with us some of the risks that possibly, we're not saying that is going to happen, or what are the possible risks that this project can run into?
Yeah. So Kenneth, I guess it wouldn't be fair for me to say the risk is there's no gold in the ground. That's not a risk that we face, right? That's a reality that is not true because we already have gold. We're extracting gold. There has been historic sales as well that we have documented. We have the veins. So there's no doubt that the gold's there. There's no doubt the gold's high grade. I guess the only thing that I can't see is in between where the mineral is on the surface. So this section I know on the surface. This section, let's say I can't see on the surface, but I can see in the tunnel. So I know this section, right? So the reason we drill, Kenneth, is to know what is in this middle area here that we can't see because it's going to be ahead of our production. So what can happen? The grade can be lower or higher. The veins can be wider or narrower. The veins can be many or less. But we always come back to facts. So we know for a fact there's 4 veins, at least, of which all along the surface is economically viable, 2 of which are visible in the tunnel, and they have been economically viable because we can sample the roof and sample the floor, okay? And we have the sales of the past. And we do know that those additional veins are there, but we need to access them. So your risks are, as you already brought up, the gold price can be very favorable and can be less favorable, right? So your ounce cost is important. And the potential of the deposit, you need to prove it with drilling. So you de-risk your production. And there are the steps that we are taking early in the investment, such as we're already producing, so there's no questions about permits. We're already in cash flow, so there's no questions about the value of the material. And we have proven the surface value and the tunnel value. So the last step is just drill in between, which is the mineral that we're going to be extracting over this next 7 years. And we'll continue to drill ahead of the mine plan, and we'll continue to update the project cash flow or projections based on the facts that we obtain from those tools of de-risking, which cost money, which is why we use investors, so we can, as a team, afford to do it correctly, the right management, the right experience, the right deposit, and you spend the money wisely on generating cash flow and de-risking your production. And that's the approach that we are taking. So every day, Kenneth, the risk is reducing. When Mr. Wee invested, it was a leap of faith because we knew that it's rich, we know about the history and the deposit, and obviously we're certain in what we're doing. This is what we do for a living. But we always have to wait for the facts, right? For the assays and the mapping and the interpretation. And that's information we have today that we didn't have ready in January.
Thank you very much. Just one last question. Is there any taxation policy in East Chile when money is being returned to the investors? Is there anything in the taxation side that you can share with us?
So, of course, Chile has tax, like everywhere else. The corporate tax is 25%. There's actually a slide on this in the PDF with a link to the Tax Department of Chile. So, Mr. Wee and I, what we're doing is it's an equity investment, but we're going to, dress it up as a loan, which is not, but we're going to dress it up as a loan in order. So we'll do a kind of convertible loan where we can, at a low cost, not have to, on the return of the original investment, have that tax aspect affect, by generating a withholding tax, in other words, affect your earnings on the original capital. Now, post that, Chile has a tax of 25%, and there's an additional 10%, 10 to 15%, depending on the countries, withholding tax of those foreign entities for the funds to go outside of Chile, right? And in many countries of the world, Chile has a double taxation treaty, which means that those countries recognize a certain amount of that taxes paid, up to 100%. In some countries, Switzerland, UK, etc., of those tax credits. But yeah, there is a tax aspect, absolutely.
Okay, now we intend to return back the capital, in the form of a loan, a return of a loan, but it's a loan together with the equity portion. That your share value remain the same, even after getting back your share your investment capital. In 2021 and 22. Kind of in terms of gold price, kind of anything can happen in a free market economy. We are likely to have a recession over the next 6 months, if not even 12 months after the COVID-19. All right. So but even in a crisis like this, gold prices are going up, and silver prices, precious metals are going up. More so gold, because gold is now classified not as a commodity under the Basel Bank of Settlement Agreement in March last year. Gold is classified as Tier 1 capital together with US dollars. It's classified as a currency. So consequently, central banks are scrambling for gold, but there's just not enough supply of gold in the market. Not enough. China reserves, they want to build up the gold portfolio, but it's only 3-4% of their reserves are in gold. Right? After this COVID event, because of the stimulus and all the financial packages the government, the different major governments are dishing out to support the economy and livelihood and so on, there will be a loss of confidence in paper currency. So which government would want to keep foreign currency as a reserve or treasury bills as a reserve? Right? So they would rather go for intrinsic value like gold. And gold does not do well in a high interest rate environment. But we are now in a zero interest rate environment. There's no carrying cost for gold. So gold becomes very attractive. So investors like the ETF funds, they increased last year, the increase in ETF investment in physical gold is up 80%. And this year, I think the percentages will be quite similar or even more. Everybody is striving towards gold as a reserve. It's an insurance. It's an insurance against currency collapse or loss of confidence in the currency system. So I think gold is there's a scramble for gold, but there's just not enough physical gold. Is that correct, Yon?
Yeah, I mean, if you want to test that theory, just go and buy some gold and share with us your experience. Let us know how, if you've ever bought an ounce or a kilogram of gold, what did you pay? At the moment, did you pay a premium? And I'm 99.9% sure the answer is going to be yes. And that premium at the moment, and even before now, there's always been a premium on gold in Singapore, even the US. There's no such thing as buying gold at gold price. The only way you can get gold less than gold price is producing it, is extracting it from the ground. That's the only way you can get the metal at a lowest possible cost, such as $1,054 an ounce.
Okay, so what we are doing is that the return of capital, you can choose US dollars or gold, the equivalent of gold. Okay, we can range for that. Also, your dividends, you can choose between US dollars or gold coin, gold bars, or whatever. And we can produce the gold coins and gold bars without having to pay a premium, right? If we produce our own gold coins and gold bars?
Yeah, so we have to pay the services for that refinery to process and to convert it to a physical product, but it's a product that has a premium. So when we sell it, we receive more than we would just selling it to a refinery, right? So a refinery will pay us 100%. A refinery will sell it for, that's why you see on the exchange, buy price, sell price. Refinery will sell it for a premium. So what we can offer our founders is lower than buying from a refinery, but higher than us selling to a refinery, right? So it's a win-win for our investors that wish to have the product. Now, if they don't wish to have it, we don't need you to have it. There's, a line of people wanting to buy our production.
How difficult is it to sell gold overseas?
I think the only challenge I see, Mr. Wee, is the cost, right? To export to Singapore or to Europe, it might cost us $4,000 to $7,000 per air freight export, which means that whether it be $500,000 worth of gold or $5 million worth of gold, that cost is the same. So the only concern will be in the early days will be the cost of the export. So it would be more beneficial to sell locally, for example, because there's no cost in air freight. But building up the volume, as you see it's ramping up, that can change, meaning that ratio can change. So, $4,000 or $5,000 on 100,000 is 5% cost, right? So that changes though as that number gets bigger. So that's the only point that I would make on the exporting of the gold to anywhere in the world, for that matter, the additional cost of the freight.
Thank you, Mr. Wee and Leon. Thank you very much for a very interesting presentation. Yeah. I think the other people may have other questions to ask.
Johnny, do you have any question, or Kang Seng?
A very simple question. What about in the event of there's this political chaos, and what's going to happen to the company, and what's the implication? Is some kind of a...
You're talking about political chaos in Chile, yeah?
Yeah, correct.
Okay, Leon, can you answer that, Leon?
Yeah. So last year there was an increase in the fare of the subway or the metro here. So a small group of students or uneducated, most of them are students that are not working, are not active, they protested, right? And it came out in the wash later that there was a lot of influence from Venezuela. A lot of the students that were arrested, supposed students were Venezuelans in the country, creating problems. It's a minority. It's a very small group. The government has taken it into consideration. They were very light-handed. Chile typically is very heavy-handed, and probably they should have been heavier, but they were more light about it. They took it into consideration. They've made changes and offered movements in equality and minimum wage and education, etc. But if you read the articles I put on the Dropbox, this first quarter was bigger than last year, and during the protest, it had no impact on the mining or production or agriculture. It was centralized into the city, into the cities where it was disruptive. But yeah, that's my take on it. We haven't seen any impact on our activities or our competitors' activity, and I think the government has a good handle on it.
Leon, this is Johnny. I would like to find out, in relation to the cost that you have reported and shared of 1,054,
Yep.
To what extent are you confident that that can be maintained, and what could be the surprises in terms of any of those factors that contribute to the total cost that might raise the cost of production?
Yeah, so what could be the impacts, Johnny? I would say that the gold grade higher lowers the cost, lower increases the cost. The vein width wider lowers the cost, narrower increases the cost, but typically when the vein's narrow, the grade's higher. When the vein's wider, the grade's lower, so it ends up balancing out. But yeah, the key factors are grade, width, ounce price. Using an external processing plant is more expensive than doing it internally, but is considered here an external plant, so that's already calculated in. The drilling campaign is not going to cost more. We use an external contractor. The external processing plant is a fixed rate. CapEx has a contingency. We put a contingency in our operations as well. So yeah, Johnny, those would be the factors that would change the scenario, as you can see quite clearly from our continued conversation of the impact of the gold price. You get the same impact in the gold grade, and that's why the first thing you do is you drill, and in drilling, you can then update this projection. So if I did all the drilling with Mr. Wee alone, we wouldn't be inviting you in at this price, right? Because we would be showing you, this is what we've done, we're already in production, we're already having cash flow, and here's our proven mine plan at the same international standard as every other major company with 25-meter intervals. So at that point, it's a different valuation, and it's a different opportunity, and it's a different risk. So the bet today is pre-drilling investment, and the results of that drilling is within 60 days. So 60 days from today, we will have the results, 60 to 90, because you have to allow for the assays and the interpretation. We'll have the results of the deposit, and we will update our all-in ounce cost, and we'll update our projected cash flow based on this new data that we have, which is how the vein